What if I give you a plan that can help you generate your first $1,000 in residual income from dividends? Yes, you read that right. $1,000 in passive income. This is the power of dividend investing. In this video, I'll reveal 8 secrets that have delivered impressive returns for countless investors, paving the way to financial freedom. So grab yourself a cup of coffee or your favorite drink, and let's kick off. 1. Comprehending dividend investments. Dividends are like a high five from a company to its shareholders, usually in the form of cold hard cash or extra shares. It's their way of saying thanks for believing in us and sharing their success. Companies can distribute dividends in different ways, like regular cash payouts, special one-time bonuses, or even more shares of stock. Each type comes with its own perks and considerations, so there's something for every company's unique financial situation. Some big players like Coca-Cola and Johnson & Johnson have been serving up cash dividends to their investors every month for years. Why consider investing in dividends? It's a common question. Dividend stocks not only pay you regularly, but also give you the chance to increase in value and grow your money over time. Throughout history, stocks that pay dividends have consistently performed better than those that don't. For instance, if you're retired and have invested in dividend-paying stocks like AT&T and Procter & Gamble, despite ups and downs in the stock market, you would have received a regular income and seen your investment grow. This is why investing in dividend-paying stocks is a proven way to build wealth over time. 2. Setting your financial goals. Let's talk about setting financial goals. If you want to receive an annual dividend income of $50,000, you'll need to determine how much to invest. If you're aiming for an average dividend yield of 4%, you would need to have a portfolio worth $1.25 million. If your portfolio's average yield is 3%, then you'd need about $1.67 million. Put simply, if you want $50,000 a year and your average yield is 4%, you divide $50,000 by 0.04, which equals $1.25 million. Setting realistic goals is important for staying motivated and focused. It's also crucial to consider your risk tolerance and investment horizon. If you're comfortable with more risk, you might aim for higher yields, but be prepared for more volatility. On the other hand, if you prefer stability, you might opt for lower yield, stable companies. 3. Choosing the right dividend stocks. Are you interested in learning about how to grow your money through dividend stocks? Let's look at how you can choose the best dividend stocks. To identify companies with a strong track record of paying and increasing dividends, look for those with a sustainable dividend yield, a reasonable payout ratio, ideally below 60%, and steady or growing revenues. You can use resources like financial news sites, stock screeners, and annual reports for your research. For example, consider a company like Procter & Gamble. They not only pay dividends annually but also increase them regularly. With a payout ratio typically in a safe range and operating in a stable industry, they are a solid choice. For more insight, check out the Dividend Aristocrats. These are companies in the S&P 500 that have raised their dividends for 25 consecutive years or more. And for the most elite, look for the Dividend Kings, who have increased their dividends for 50 years or more. These companies have a proven track record of delivering consistent profits and creating value for their shareholders over the long haul. To protect your investments from market downturns, diversify by spreading your money across different sectors like tech, healthcare, and consumer goods to minimize the impact of sector-specific challenges. For example, consider investing in a mix of stocks such as Apple, Pfizer, and PepsiCo, covering the tech, healthcare, and consumer goods sectors respectively. Diversification means dividing your investment portfolio among different asset categories like stocks, bonds, and cash. By doing so, you not only spread your risk, but also create a balanced approach to growth and income. Remember, when it comes to investing, diversity is key. 4. Reinvesting dividends. Are you ready to give your investments a big boost? One of the most effective moves in dividend investing is to use your dividends to buy more shares and benefit from compounding returns. For example, if you receive a $1,000 dividend with a 5% yield and reinvest it, you'll have $1,050 to generate more income in the next cycle. Let's say you invest $10,000 in a stock with a 5% dividend yield. After the first year, you earn $500 in dividends. If you choose to reinvest those dividends, the next year you'll be earning dividends of $10,500 instead of just $10,000. This compounding effect over 10, 20 or 30 years can significantly increase your total returns. To make reinvesting easy, many companies offer dividend reinvestment plans, GRIPs, which automatically reinvest your dividends into additional shares of the company. These plans often come with little to no fees, making them a cost-effective way to grow your investments. 5. Tax implications and strategies. Understanding how taxes affect your investment income is important. The taxes on dividend income can vary based on where you live and how much you earn. In some places, certain dividends are taxed at a lower rate. It can be helpful to hold stocks that pay dividends in accounts that have tax advantages to lower the amount of tax you owe. In the United States, specific dividends are taxed at rates for long-term investments, which can be much lower than regular income tax rates. If you keep your dividend stocks in a Roth IRA, you might not have to pay taxes on the dividends at all. It's also crucial to stay up to date on possible changes in tax laws. Governments can change tax rates and rules, which might affect your plans for earning dividends. Talking with a tax professional can help you make the most tax-efficient investment decisions. 6. Monitoring and adjusting your portfolio. Make sure to regularly check and adjust your investment portfolio to keep it in line with your goals. Pay attention to factors like dividend yield, payout ratio, and earnings growth. You can use portfolio tracking tools to monitor your investments and make changes as needed. For example, if one of your stocks has grown significantly in value and now makes up a larger part of your portfolio than you planned, you might need to sell some of that stock and invest in others to maintain your desired balance. Keep an eye on market conditions and economic indicators, as they can affect your investments. For instance, changes in interest rates can impact dividend yields and stock prices. Stay informed and be ready to make adjustments when necessary. 7. Avoiding common mistakes. Remember that high dividend yields may not be sustainable and could indicate financial problems. It's important to diversify and not put all your money into one stock or sector, as it can be risky. For example, Frontier Communications, a high-yielding stock, cut its dividend due to financial troubles. Make sure to research and understand a company's dividend payments thoroughly. Take your time to analyze potential investments and avoid making quick decisions based on short-term market changes. By staying disciplined, you can avoid common mistakes and build a successful dividend portfolio. 8. Long-term mindset and patience. Remember, it's important to have a long-term mindset when investing in dividends. The stock market can change a lot in the short term, but if you stay patient and focused on your goals, you can build significant wealth over time. Instead of trying to time the market, focus on spending time in the market. For example, consider an investor who bought shares of Johnson & Johnson 30 years ago and held on to them. Despite market ups and downs, their patience has paid off with substantial dividend income and capital gains. To keep a long-term mindset, set clear financial goals, regularly review your portfolio, and stay informed about market trends. Keeping a journal of your investment decisions can also help you stay focused and learn from past experiences. Outro. Thank you for watching. If you found this video helpful, please give it a thumbs up, share it with others, and subscribe to our channel for more investment tips. And as promised, here's a bonus tip. Consider looking into international dividend stocks to diversify your portfolio even further. Some foreign companies offer attractive yields and growth potential. Additionally, exploring dividend ETFs can provide exposure to a wide range of dividend-paying stocks with ease. Happy investing!